Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalysts talk. Today, we're looking at supermicrocomputer.
If you find our talks useful, please consider subscribe, like, and comment underneath.
So we have a mountain of data to get through today. This isn't just another earnings report where we parse through a few percentage points here and there.
No, not at all.
This is one of those moments where the numbers are so large, they almost don't feel real. You know, you have to double check your screen.
Almost.
Yeah.
I absolutely double-checked my screen. I think I refreshed the page 3 times just to make sure I wasn't looking at a typo.
Right.
We are talking about supermicrocomputer, and look, I know in this market we throw around words like surge and rocket ship pretty loosely. But what happened with their Q2 fiscal 2026 numbers is, well, it's explosive.
It really is. It's the kind of report that sets the tone for the entire AI infrastructure sector. If anyone was worried that the AI trade was slowing down, this report is a very loud counter-argument.
Exactly. So let's not bury the lead here. I was looking at the headline numbers, and I mean, my jaw hit the floor when we're talking about revenue. For just this quarter, Q2, they hit $12.7 billion.
$12.7 billion in 90 days.
And just to put that into context for everyone listening, because once you get into the billions, it all starts to sound like monopoly money. That is up 123% year over year.
They more than doubled the business.
Compared to last year, yeah.
And perhaps even more impressive is the sequential growth. It's up 153% quarter over quarter. I mean, remember, in Q1, they got $5.0 billion.
Right.
They have essentially more than doubled their revenue in just 3 months. That's incredibly rare for a hardware company dealing with physical goods, supply chains, all of it.
That is wild. Usually you see that kind of percentage jump in a small cap software startup, not a manufacturing giant. And they didn't just beat the estimates, they crushed them. The consensus was sitting at $10.4 billion.
And they cleared that by over $2 billion.
It's just a massive beat.
A massive beat. And it flowed all the way down to the bottom line. The earnings per share, the non-GAAP EPS, came in at 69 cents.
And the street was looking for 49 cents.
49. So that's a 40.8% beat on profitability.
Okay, so clearly business is booming.
Yeah.
But we need to play detective here. Where is all this coming from? I mean, we know AI is hot. We get that tagline. But specifically, what pulled the lever here? Is this just, generic server sales?
It's not random. It's a combination of two very specific drivers. First, the demand for AI infrastructure is actually accelerating.
Accelerating, not slowing.
We aren't seeing a slowdown. We are seeing a ramp up, specifically in what we call rack scale systems.
Rack scale. Okay, let's unpack that.
Yeah.
We aren't talking about selling a laptop here.
No. The big players, the hyperscalers like Meta, Google, Microsoft, they aren't buying individual servers anymore. They need entire server racks, fully integrated, wired, and ready to go.
A data center in a box, basically.
A data center in a box, essentially. And they need it yesterday.
Right, so they want the whole ecosystem delivered at once.
Precisely. And the second factor is execution. Remember last quarter, there was a lot of talk about backlog and supply chain delays.
Everyone was worried they couldn't build fast enough.
Exactly. Well, this quarter, they cleared $1.5 billion in delayed shipments from the previous quarter. That bottleneck just broke open, and the revenue flooded in.
So it's a mix of insatiable demand and finally getting the plumbing fixed to deliver the goods. You mentioned the net income to GAAP net income sitting at over $400 million. That's real money.
$400.6 million to be exact. It proves they can translate that top-line revenue right into the bottom line.
Okay, so here is where I have to play the confused investor. Because if I look at these numbers, 123% growth, massive beat, bottlenecks clearing, I'd expect the stock to be mooning.
Right.
I'd expect champagne corks popping on Wall Street. But over the last week, it's been volatile. It's actually down about 4.6% over the last 7 days leading up to this. Why the hesitation? What is the market worried about?
It's the classic good news, bad news situation, and the bad news is buried in the margins. This is the pivot point for the bear case, and it's what has the analysts hesitating.
The margins. Talk to me.
Gross margins compressed significantly. In Q2, they came in at 6.4%.
Oof. 6.4%. That sounds incredibly thin.
It is thin. For context, in Q1, they were at 9.5%. So that is a steep drop-off. And in the hardware world, when margins get that tight, investors get very nervous.
It suggests you might be selling dollar bills for 95 cents just to get revenue on the board.
It screams commodity business.
So why do they drop? Is it just because they had to rush those delayed shipments out the door and pay overtime?
Part of it is supply chain costs and expedited shipping, yes. But a big part is what we call mix shift.
Mix shift. That's one of those finance terms that sounds harmless but can kill a stock price. Break that down for us.
Think of it like a bakery. If you sell a single croissant to a customer walking in, you charge full price and you make a high margin. But let's say a huge hotel chain comes in and says, we want 10,000 croissants, but we want a bulk discount. You make a ton of revenue, but your profit per croissant drops. That's mix shift.
So they sold a different mix of products this quarter, likely some massive lower margin contracts to huge hyperscaler customers, which drags the average down.
That's the theory. They are chasing volume over percentage profitability.
That's a dangerous game if it stays that way. Did management say anything to calm people down? Do they have a plan to fix this, or is 6% the new normal?
They do have a plan, and this is where you have to listen closely to the earnings call. They are projecting margins to tick back up. They're guiding for an increase of 30 basis points in Q3.
30 basis points, that's what, 0.3%? It doesn't sound like a lot.
It's a start. It shows the bleeding has stopped. But the real strategy is something they call data center building block solutions.
Data center building block solutions. Sounds like marketing speak. What does it actually mean operationally?
It's their strategy to regain premium profitability. Instead of just selling generic servers, they are selling modular, customizable architectures. Think of it like Legos.
Legos.
Yes. Most competitors have rigid designs. You buy Model A or Model B. Supermicro has designed their systems so they can snap together different components. Storage, cooling, processors, very quickly to match exactly what the client needs.
So it's more efficient for them to manufacture.
And it offers higher value to the customer because it's tailored. The idea is that as they lean into these building blocks, the margins naturally expand because they aren't just shifting commodity boxes.
So move away from generic hardware and move towards specialized, flexible solutions that command a better price.
Exactly. And that actually leads perfectly into why they're winning against giants like Dell or HPE.
That was going to be my next question. You've got these legacy titans, Dell, HPE, who have been doing servers since the dawn of time. Why is Supermicro winning this race? Is it just luck?
It's definitely not luck. It's a technical edge that they've been cultivating for years.
Like,
And the biggest one, liquid cooling.
liquid cooling. We hear this term a lot with AI. Why is it such a moat for them? Explain it like I'm 5. Why can't we just use fans like we always have?
Physics. The new AI chips, the GPUs running these massive models, get incredibly hot. Traditional fans just can't keep up without turning the data center into a wind tunnel.
Wow.
If you try to cool a modern AI cluster with air, it's loud, it vibrates the delicate equipment, and it uses a massive amount of electricity just to spin the fans.
So it's an energy bill problem as much as a heat problem.
A huge energy problem. Thermicro has deep expertise in liquid-cooled AI-optimized servers. They pump coolant right to the chip. This allows them to pack more power into a smaller space without it melting down.
So the customer saves money on electricity and saves space. It's basically saving rent.
Right. And they can do it fast. That's the second part of their moat. Speed. Their building block architecture allows for faster time to market. When a hyperscaler, like a Microsoft or a Meta, wants to deploy a new AI cluster, they want it now. Supermicro can customize and ship faster than the rigid supply chains of the bigger competitors.
So while the big guys are having meetings about changing a production line, Supermicro is already shipping the racks.
Essentially. And once those racks are in, there is a stickiness factor, high switching costs. Once a data center is designed around Supermicro's power and cooling architecture, you don't just rip it out and switch to Dell next week. Plus, they have IP and energy-efficient designs that saves these companies millions. That protects their market share.
It makes sense. In a gold rush, you buy the shovel from the guy who can get it to you today, not next month.
Exactly.
Let's switch gears to the boring stuff that isn't actually boring. The balance sheet. Financial health.
Right.
Because growing this fast usually eats cash like crazy. You have to buy the parts before you get paid for the server.
Right.
Are they burning through money to sustain this growth?
This was actually the hidden gem of the report for me. It's a specific metric called the cash conversion cycle.
Okay, break down the cash conversion cycle. Why should we care?
It measures how fast a company can convert its inventory into cash. It's the speedometer of their operational efficiency.
Okay.
In Q1, their cycle was 123 days. That means it took them 4 months to buy parts, build a server, sell it, and get the money in the bank.
That's a long time to have cash tied up. That's dangerous.
It is. But in Q2, that number dropped to 54 days.
Whoa. They cut it in less than half.
Yes. That is a massive operational improvement. It means they are turning inventory into cash much, much faster.
Which you have to do at this scale.
You need that cash to buy more parts for the next order immediately. This improvement proves they aren't just growing sales, they are fixing their operations to handle the scale.
That is actually huge. It explains how they cleared that backlog too. What of the rest of the liquidity? Do they have enough cash on hand?
They're solid. They ended Q2 with $4.1 billion in cash.
And debt.
Total bank and convertible note debt is about $4.9 billion. So if you net that out, they have a net debt of about $787 million. For a company generating $12 billion in revenue a quarter, that is very manageable.
Very manageable. And I saw a number regarding bookings that caught my eye. The backlog. This is the crystal ball for future revenue.
The backlog is the future revenue waiting to happen. In Q2, they had bookings of $21.0 billion.
$21 billion.
Up 502% year over year.
Okay, stop. 502% year-over-year growth in bookings. That puts the demand is slowing argument to bed, doesn't it?
It completely destroys it. It proves that the demand for AI infrastructure isn't just a 2024 or 2025 story. It's continuing to ramp. You don't get $21 billion in orders if the AI bubble is bursting.
So we have explosive revenue, improving efficiency, massive backlog, but margins are a bit tight. Let's talk about the stock itself, the chart.
Yeah.
Because for a trader, Supermicro is, well, let's call it exciting.
Exciting is a polite word for volatile. The stock has a beta of 1.54.
Which means it moves 50% more than the market on any given day.
Right. It's not for the faint of heart. After this report came out, specifically on February 3rd after hours, the stock surged 7.3%.
But the open the next day was choppy.
Very choppy. But that after-hours surge shows that buyers are lurking. They see the beat and they want in. But during the regular session, you see the margin concerns weighing it down.
A battleground.
It's a battleground between the growth bulls and the margin bears.
And the valuation. It feels like an AI stock should be trading at 100 times earnings, but this isn't.
No, it's not. The PE ratio is around 23.74.
23. For a company growing revenue at 123%, that sounds incredibly cheap. That's value stock territory.
It does look like a high-momentum AI play that is surprisingly affordable relative to its growth. But that valuation reflects the risk, the margin risk, and the competition risk. The market is pricing in skepticism.
There is a bit of a paradox here. I'm looking at the headlines, and they are overwhelmingly bullish. Blowout earnings, record revenue, sales double. But then I look at the analyst ratings. The consensus is still a hold. The average price target is $46.19. Why the disconnect? Why are the analysts sitting on their hands?
It's the show me state of mind. Analysts are conservative by nature. They see the revenue growth, but they are hung up on that margin compression. They want to see if that 6.4% gross margin was truly a one-time bottom or if it's a new normal.
Oh, okay.
If margins stabilize in Q3, like management says, you will see those upgrades roll in fast. But for now, they are hedging their bets.
So the market is waiting for proof that they can be profitable and big, not just big.
Exactly. Profitless growth or low profit growth is punished in this environment.
Well, let's look at the future then. What is management telling us to expect? Because they give us guidance for Q3 and the full year.
The guidance is strong. For Q3, they are projecting revenue of $12.3 billion at the midpoint.
And the consensus was?
The consensus was only $10.2 billion. So they're guiding 20.5% above what Wall Street expected.
That is a confident guide. Usually, companies try to lower expectations so they can beat them easily. This feels aggressive.
It is aggressive, and for EPS, they are projecting at least 60 cents, beating the 51-cent consensus. But the big number, the one that really matters for the long-term thesis, is the full fiscal year 2026 outlook.
Hit me with it.
They raised the outlook for net sales to at least $40 billion.
$40 billion in 1 year.
$40 billion. Just a few years ago, this was a company struggling to break a few billion. Now they are a titan. They are entering the Fortune 100 conversation.
And macro-wise, does the environment support this? We hear about interest rates potentially coming down. Does that help them?
Absolutely. The AI capital expenditure surge, the CapEx cycle, is still in full swing. The hyperscalers are ramping up GPU purchases. But if interest rates get cut, capital becomes cheaper.
Right.
That encourages even more data center buildouts from the Tier 2 cloud providers and enterprises. So the macro tailwinds are aligning perfectly with their product ramp.
It sounds like the perfect storm for them, in a good way.
It really is.
Okay. We've unpacked the numbers, the margins, the moat, and the guidance. It's time for the verdict. You know the drill. Give me the score.
I'm giving this a bullish score of 900.
9 out of 10. That is high confidence. Walk me through the thesis one last time.
It's simple. First, the growth is undeniable. You cannot fake $12.7 billion in revenue or a $40 billion annual guide. The demand is real.
Hmm.
Second, the margin issue, that 6.4%, I view it as transitory. It's growing pains. They are clearing old backlog and shifting product mix. The strategy with the building block solutions is sound.
And the efficiency.
That's the third pillar. The 54-day cash conversion cycle proves management knows what they're doing. They can handle the scale. They aren't drowning in their own success.
So how do you play this? Is this a trade or an investment?
This is a multi-year hold. We are in the early innings of the AI infrastructure build-out. It's not a one-quarter pop.
Okay.
The recent price dips, the volatility we talked about, I view those as entry points. There is potential for significant upside here if they hit that $40 billion target.
You think the market is mispricing that margin fear?
I do. I think the revenue scale will eventually overwhelm the margin concerns.
That is a compelling case.
Yeah.
It's rare to see a company grow this fast and get punished for it because they didn't make quite enough profit on the massive pile of money they brought in.
It creates opportunity for the attentive investor.
Absolutely.
Hmm.
Before we wrap up, I want to leave everyone with one final thought.
Mm.
We talked about those data center building block solutions.
Mm-hmm.
If that strategy works, if they can actually customize these servers at scale and get those margins back up to historical levels of 10% or 12% while keeping this revenue growth, do the math on the earnings, the current stock price wouldn't just be cheap. It would be severely undervalued.
Right.
The market is pricing them like a low-margin hardware assembler. If they prove they are a high-margin technology partner, the multiple expansion could be huge.
That's the catalyst everyone should be watching.
All right, that's all we have time for today on Smart Wealth with Joshua. Thanks for diving into the numbers with us.
Thanks for listening.
We'll catch you in the next one. Take care.